Amazon.com reports its quarterly earnings after the closing bell Thursday. So, what kind of growth can investors expect from this already massive online retailer? Joining us now to talk all about that is Michael Pachter. He's the managing director of equity research over at Wedbush Securities. And thank you so much for joining us here on the Tech Bet. Michael, what's the one thing that you're going to most look forward to in terms of hearing about what Amazon reports in its quarterly results? Let's just say that Amazon isn't entirely transparent with regard to how their business breaks down.
Well, I think table stakes are that their retail business grows in the high teens, so 17, 18, 19%. If they don't get there, people are going to have a problem with the earnings report, no matter what they say about anything else. I also think table stakes are that Amazon Web Services grows by about 50%. And I think that's going to persist for at least the rest of this year and maybe into the next couple of years. So you want to see hyper growth top line for Amazon Web Services and very solid growth top line for retail. Beyond that, I don't think investors are going to care very much so long as Amazon makes a profit. So we really have to see that they are going to deliver a profit and that it's growing. And I think the biggest disconnect right now is that the sell side is just out of touch with what Bezos is thinking. The sell side has earnings going up almost fourfold this year. Literally, they made $1.25 last year. The sell side has them making $4.79 this year. I think the number is probably closer to $3. It might even be below $3. I think in Bezos's head, as long as he doubles earnings, he's doing a good enough job for investors. And I think what most of us disregard is Amazon is never going to run out of new things to spend money on. So we're seeing big advertising campaigns for things like Echo. You're seeing the launch of really interesting products like standalone video subscriptions and monthly Prime subscription. Those are new things. They're going to have to market the heck out of them. You're going to see things like, expanded grocery delivery, restaurant delivery. So they're going to try to take on, the Grubhubs of the world. That stuff costs money, and it costs a lot of money to promote. So again, I think my competitors have probably missed the boat on how much operating leverage we're going to see from this phenomenal revenue growth. I think Amazon will deliver very, very modest earnings growth on very solid revenue growth.
Well, let's kind of remain on that topic here. I mean, you can argue, one could certainly argue, Michael, that investors of all varieties in Amazon have given them a pass, so to speak, over the years with their financial results. Now, let's talk about some of those revenue profiles. Amazon's retail side, the Prime subscription specifically, play a huge part in the company's overall revenue scheme. And Amazon recently said that it's going to offer that Prime Video service as a standalone service, right, for a price that makes up the majority of what Prime membership per year would cost. So what's your take on that, and how is that going to impact the company's overall revenue line?
I think the standalone video service is intended as a hook. I think that they hope to get, a handful, a few million, 2 or 3 or 5 million below median income households to sign up. And I think they hope to upsell those people and explain to them, hey, you're paying $8.99 a month, $107.88 a year. Do you realize you would save money if you signed up for Prime on an annual basis? But the customer that's going to be attracted to that is that fickle Netflix customer who churns in and out once or twice a year. And there are millions of those. I would say my estimate is there are around 6 million people who quit Netflix every year and then join back in the fall. I think Amazon would like to get them hooked on Amazon content and then upsell them Prime. I think the bigger product launch is this monthly Prime subscription at $10.99, which is $131.88. So a very expensive Prime membership. Who's going to do that? Somebody who only wants it at holiday. So I think in November and December, you're going to see a surge in Prime memberships, not as if Amazon's going to tell us that, but you're going to see it. And you're going to see huge market share gain November, December from people who are seasonal shoppers. That's going to hurt established brick and mortar guys who sell whatever Amazon sells at Christmas. And I would say TVs, bad for Best Buy. I think Best Buy in particular is going to get hammered by this monthly Prime subscription at holiday.
You know, it's interesting you bring that up because Amazon's web services is a scalability sell point, right, for companies.
Right.
In this case here, a monthly Prime membership could be scalability in terms of the consumer out there. Only use it when you really have to. Now, there's a lot of moving parts you just spoke about here. You said, generally speaking, your sell-side analyst community have it generally wrong. You right now have an outperform rating and a $700 price target on Amazon. So what exactly about this company really backs that outperform with that kind of a price target?
You know, the difference between Amazon, which I have rated outperform, and Netflix, which I have rated underperform, is exactly the word you use, scalability. Anytime Bezos feels like turning on the earnings taps, he can. So when he decides, I found enough things to invest in, and some year, let's say 2019 or 2020, my investment profile is going to be steady state. I'm not going to lift the amount of investment. He's going to drop a ton of earnings to the bottom line. I don't think Reed Hastings has the flexibility to do that. He doesn't control his content costs, so he can't just turn on the profit taps. I think investors have that one wrong. So again, I look at scalability. I see Amazon as having a ton of flexibility to stop promoting some of their plans. I mean, I think restaurant delivery might be a difficult one for them to pull off. I think grocery delivery might be a tough one for them to pull off. The device strategy sometimes is baffling. Video I kind of get, but again, if they just find we're spending enough, it's $10 billion a year and we're not going to spend 11 this year, then that extra $1 billion will drop to the bottom line. And I think that happens this decade. So I'm very confident that this company is going to get to, you know, something like $500 billion in revenue in the foreseeable future and drop a ton of profit. I think $20, $25 a share in profit. So yes, I think it actually is worth $700.
Well, Michael, it certainly was. Amazon, one of the star performers, really, one of the shining stars in the S&P 500 last year, and certainly in the consumer discretionary sector as well. So we'll see if it can continue that trend in 2016. Michael Pachter, thank you so much for joining us here. That's Michael Pachter, Managing Director of Equity Research over at Wedbush Securities. And thanks for watching today. I'm Dominic Chu. Have a great day.
Hey CNBC fans, thanks for checking out our YouTube channel. Here you're going to find videos packed with all of the information that you need to be smarter about your finances. You can subscribe by clicking right here and click on all the videos around me or the I right here to watch the latest from CNBC. Thanks for watching.